being the financial arm of our team, you can tell us a little bit about this PMI that we keep hearing about.
Yes, so PMI is called private mortgage insurance. And it's interesting because there's a lot of myths that still go on with that. And one of the questions that I have, or the second most popular question besides, is it the right time to buy, is I want to put 20% down so I eliminate PMI. And a lot of times people don't even understand what it is. They've heard from their parents that it's really expensive. And in the end, it's sometimes better to take the PMI and keep the cash. So what PMI does is it protects our investors, so Fannie Mae, Freddie Mac, whoever it is that's doing the loan. It protects them from default on the mortgage. So typically if you're putting less than 20% down, PMI will be required. When you go FHA, you're not only going to have a monthly PMI, but you'll have upfront PMI that's financed in the loan. The only reason for that is because FHA is a little more aggressive, a little bit more relaxed with their guidelines, so they're taking on a little bit more risk. So not only do they want to collect that monthly, they want something upfront and it's financed into the loan for them.
I see. Well, speaking of that, I hear there are multiple ways you can pay PMI.
There are. So when you're going on the conventional side, you can pay it monthly, like I said. So, and the premiums are different based on a lot of factors when it comes to conventional. Versus FHA, you've got 2 sets of PMI and that's it. But when it comes to conventional, you can either pay it monthly, and then as you build equity, it decreases and it eventually will go away. Or you can pay it up front. So let's say someone is close to putting 20% down and the market is not as aggressive as it has been. So home values are not building equity as fast as it used to be. It may be smart for them to pay that PMI up front and then they don't have that monthly expense.
Oh, okay.
Yep. So people who are on fixed incomes, things like that, that's a good option for them. And then we also have what we call lender paid mortgage insurance. So depending on where rates are at, we can actually build the PMI into their interest rate. So maybe their rate will be an eighth or a quarter higher each month, but now it's built into the rate. It's not a monthly payment, and you can refinance still just like anything at any time.
And speaking of refinance, you can do that to knock the PMI off, right?
You can. So typically when you reach 23% equity in the home automatically based on your payment schedule, it will drop off. However, let's say home values are increasing significantly and very fast. So you can contact your lender. You can say, hey, I'd like to order an appraisal, see if that equity is there, and you'll pay for that, but it's only, $400 or something. And if they determine that the equity is there, you can drop the PMI that way. But sometimes you just got to remember, some of the PMI companies do require them to keep it for a certain number of years because just like anything, they don't want a short time frame, let's say, of them paying PMI because they're not making any money that way. So sometimes they have a 12-month or 2-year period, but there are multiple ways that you can drop PMI without having to go through the whole refinance process.
Yeah. And if you want to be sure before you spend that $400 on the appraisal, if you had a quality realtor that you worked with, they can take a look at what your home value is and see if it may be worth doing that.
That's right. So you do what? It's called a CMA, is that right?
That's right.
Where you're going to pull homes. I mean, tell us what does that all entail exactly?
So essentially we look at your home value based on what's going on in your local market and see if it makes any sense to go forward with the appraisal.
That's the benefit of having a qualified and educated realtor, right?
Hey, I do what I can.
Yeah.
Well, thank you very much.